G'day, Scuddy here. Risk assets are starting to wobble again, but this time it's not about tariffs, geopolitics, or even the Fed. It's the bond market. Just look at what's happening in US Treasury yields right now. The 30-year yield shown in the bottom right pane is trading at the highest level since 2007, while yields right across the curve continue to push higher rapidly. When yields move this aggressively, you'd expect markets to be pricing a much more hawkish Federal Reserve. But that's not really happening on this occasion. Markets still only price around 16 basis points of Fed tightening by the end of this year and roughly 35 basis points by the middle of 2027. This is increasingly a term premium story. In simple terms, investors are demanding greater compensation to hold long duration US debt because of concerns around deficits, treasury supply, and inflation uncertainty. That matters because US 10-year real yields are now back near levels that previously coincided with significant stress in global equities. If you're wondering what real yields actually are, they're simply Treasury yields adjusted for inflation expectations. In other words, they reflect the inflation-adjusted returns investors receive for holding US government debt. And this chart really drives the point home. What you're looking at here is Vanguard's all-world equity ETF, with red shaded periods highlighting prior occasions where US 10-year real yields traded around these levels. As you can see, those periods rarely proved particularly comfortable environments for global equities, often coinciding with heightened volatility, weaker risk sentiment, and sizable drawdowns. Importantly, this isn't the sort of yield rise normally associated with a strengthening economy. If yields rise because growth is improving, equities can usually cope. But when yields rise because investors demand a higher term premium, it tends to be a much tougher environment for risk assets. We're also seeing rates become a much more dominant driver across broader markets again. Over the past month, the correlation between the US dollar index and US 2-year yields has jumped to 0.87, while the relationship with 10-year yields sits above 0.8. At the same time, the inverse relationship between the dollar and global equities has strengthened sharply, telling you that rates are increasingly becoming the dominant macro driver once again. When both nominal and real Treasury yields rise sharply together, as they are now, higher returns in fixed income can start acting like a sponge, soaking up capital from other parts of the world and other asset classes. Why chase riskier assets elsewhere when you can suddenly receive attractive inflation-adjusted returns parking money in US Treasuries? It tightens financial conditions globally, drains liquidity from risk assets, and places pressure on valuation multiples. Best of luck with your trading. I'll catch you next time.